Hi, this is Mr. Guy, and I'd like to talk to you today about risk and return in short-term and long-term investing or savings. So, common word that we have is risk, and this is your chance or probability of loss of your funds or your money. So, entrepreneurs are saying basically they're the type of people that take a lot of risk to start a business, and they get the reward of actually making profit, making a lot of money. So, if you have a higher risk, there's a higher chance that you might lose your money. If there's a lower risk, there's a low chance of losing your money. So in some investments or some items, you might have a very low risk, and that would be savings accounts, which are guaranteed up to $250,000, CDs, certificate of deposits, again, which are guaranteed by the federal government of up to $250,000 per deposit. Or you might have a little bit riskier items that might be bonds. They could be municipal bonds, corporate bonds. Then you have stocks, and as you get the greater chance of losing your money, you get a higher risk. So the riskiest items might be junk bonds, or they might be aggressive stocks where your chance of losing is a lot, but you also have a larger reward. So this return is basically looking at, based on the risk, how much will you be returned? So if you have a low risk, you have a high return. If you've got a high risk, you have a high return. So you look at your risk return basically relationship. So if you don't want any risk, you're going to get a smaller and smaller return, but there is no chance of you losing your money. If you want a higher return, you're going to take more risk. And if you want the highest return, like 20, 30, 40%, your risk is even greater. So there's this trade-off or relationship between risk and return. So make sure that you know that the higher the return, the higher the risk, the lower the return, the lower the risk. So if you're looking at low returns, you're looking at savings accounts, you're looking at CDs, you're looking at government bonds by the federal government. A little bit higher return could be corporate bonds and municipal bonds, or maybe some kind of other bonds by other institutions beside the federal government. Then you have large stocks, dividend stocks, and then you have newer stocks, and basically you might find some high return could be in some corporate stocks that are international. You might find some brand new stocks where new technology, new company, and it's very risky, but your return is very high. Now, long term normally is over a year, so you're looking at 1 year or longer. Short term is less than a year. That's just in general. But I look at, when are you going to need your money? If you're going to need the money in short term, you're basically going to put your money into savings accounts. You'll put it into maybe short-term CDs like 6 months or 90 days. Long term, you can put in mutual funds or stocks. You have more time to make money, and normally you put that in stocks. You put it in some types of bonds, possibly some types of mutual funds. I look at long-term investing for your college. Long-term investing is for your retirement. Short-term is savings, and that might be savings for a car, savings for vacations, savings for a Christmas gift. So that's less than a year, longer than a year. So you might need to save up for college expenses. You might save up for a baby. You might need long-term saving up to buy a house. So you're going to need to put more money in an investment, and you're going to need to have bigger returns. So a lot of times for long-term items, you might want a higher return. You might want 10, 15, 12%, but you might take a higher risk. Short term, you don't want to lose your money. You need it. You're saving for a car. You're saving for a vacation, so you want to make sure that you get it. So you might put short term into a savings account or in a short term CD. Hope this makes sense, and if you have any questions, feel free to ask. You can post after this video, or you can ask in class.